Welcome to Unblocking the Chain. I'm your host, Ash Cooper. In today's episode, we're welcoming back Jamie Coutts from Real Vision. We'll discuss the latest political impacts, Trump's election, and liquidity issues facing the market. And as always, looking at the evolving landscape of the digital asset market. Jamie, welcome.
G'day, Ash. Nice to see you again, man.
Welcome back. Looking very relaxed today, mate.
Yeah, well, it's December.
Christmas is coming. So why don't we jump into it? A lot of talk around Trump, post-Trump, president-elect. The thing I'm looking at now is obviously he's building out or trying to build out his team. A lot of them are looking very pro crypto, digital assets. How do you think that plays out? Are we going to see pushback from the Democrats going forward? I mean, this is challenging. I saw the the new FBI director. I mean, he's very aggressive by the looks of it.
Yeah, that's a really interesting appointment. So far, couldn't be more happy with the appointments, to be perfectly honest. That's if you're in favor of, cleaning up the government morass and the bureaucratic state, which has really strangled United States' productivity and growth. So, you've got basically accelerationists now in charge, with Musk there and Vivek. And I think that bodes very, very well for technology adoption, and some of the big secular trends that are happening, of which obviously crypto and blockchain is definitely right up there as one of the most prominent ones. So I think that I don't see at this point anything that makes me concerned about the direction that has been set pre-election in this sort of president-elect period. It looks like, the appointments have been consistent with what they outlined, leading into the election. And some of the appointments have even impressed me by, I guess, how audacious they are.
I totally agree. And again, it's not, I don't think this is off script. It's exactly what the team said.
Yeah.
But it's aggressive, right? And it's going to rock some boats.
Yep.
I don't want to go into the details but people, the system in which people were operating at a political level is changing, right? Like trading your own stocks or trading stocks as a senator. I mean, these things are going to change, right? And this is going to upset a lot of people.
Term limits. It's the reform that we all hope for. At least, those of us who are sort of in the camp that were of the view that there was a problem. There was a cancer inside the US government. It was the establishment. It was these, lifers that have been in the system, these unelected bureaucrats that were running departments. It was the regulators who were not actually legally allowed to impose the rules that they have, which the Chevron case is now quite clearly defined as being sort of outside the bounds of the regulator's jurisdiction, which will hopefully see a lot of unwinding of these regulations. But in terms of just specifically around crypto and blockchain, will there be pushback from the Democrats? That lobby group that Coinbase, I believe, was really behind or started, showed that it was overwhelmingly bipartisan in terms of who was elected into Congress, that were in support of crypto on both sides. And you've got, if there's hopefully a silver lining out of this, that you get some self-reflection from the Democrats about the direction they were heading in, and that you start to see the younger generation come through, more moderate, sane voices start to influence policy. I don't think they're going to go back. I think Elizabeth Warren's days are essentially numbered, if not already over. She cost them in many ways that election. So there were so many crypto voters, and obviously the support was overwhelming. So no, I think it all bodes very, very well. The only thing that I think is a bit rocky, maybe on sort of the macro side of things, is exactly how they execute a policy which is pro-growth and a reduction in government spending, and what that means for liquidity, because we've just been used to TGA, basically drawing down large amounts of money and injecting that into the market, all very, very inefficiently through government programs and basically slush funds and pork barreling and all this sort of stuff. But it did have a huge impact on the market. What happens when government spending is cut? I personally believe that's just going to be offset with tax cuts and a massive boost in economic growth from the private sector that's been constrained by way too much government spending and whatnot. But it's interesting. It will just be interesting to see how the liquidity dynamics sort of play out. I think it'll be a little bit rocky if they don't get the execution right. It will be very rocky if they don't get the execution right. But just the way that everyone models liquidity and thinks about liquidity, because we've been in this sort of like big government era now for 20 odd years, arguably even longer. And if that, Doge and all the reforms come in, how that affects liquidity and the way that, guys like me and all the other people who follow liquidity factors like you and running a fund, look at the metrics that we see on Bloomberg that sort of follow this and what that means. But yeah, I think it all bodes very, very well. I think the biggest problem is probably the Republicans, the rhinos in the Senate, how they interfere with the president's agenda is probably more problematic because they have control of, the Republicans have control of both houses. So it's maybe more of an internal issue.
Yeah, it's an interesting one. I mean, obviously the sweep is good, but there's going to be some legacy people in there. But so let's go down the liquidity line now. Obviously, you've been doing some work on it, the M2, global M2, etc., and the good work that Real Vision does on also corporate balance sheets or banks lending as well added on to that, which is a key component. Obviously, that's seen a little bit of a drop off. What are you thinking about liquidity at the moment? I mean, my view is that liquidity has to stay around for the system, right? Whether it's QT, less QT, QE, issuing more debt. The system is reliant on liquidity, right? Or debt to be available.
Yep.
I think the headline way I would think about it is it's a refinancing problem.
Yeah.
And if that's not easy to do, we've got bigger problems. So
yes, that doesn't change, and I'm sure that the president and the administration are completely aware of that. So, look, I think at the moment we've seen US dollar spike, we've seen yield spike, we've had very high volatility in the treasury market, which is very problematic for liquidity, globally, because that is the collateral layer of the entire system. I don't know where US dollar is today. So what's today? Today's the first or the second?
Second.
The second. So just a couple of days ago, DXY hit sort of 107 and it did quite a large reversal. And that sort of is the top of the range that it's been in for 12 months or so. So leading into the election and then thereafter, everything like liquidity was tightening, and we're seeing global M2 contract by about 2.5 trillion on the back of mainly the dollar tightening. So that is, I think that's really, really problematic. And there was Fed minutes that were released last week, which indicated that the governors are aware of it. They're basically instituting some tweaks in terms of liquidity because they realize that at the moment it's becoming problematic. And what that means is I think they were lowering the overnight reverse repo rates to try and get more liquidity out of money markets to support treasuries. And there was effectively an acknowledgement that QT is going to have to end. So that's all sort of baked into the Kate. And at the moment, crypto Twitter and the markets are sort of looking at this contraction in global liquidity and starting to get a little bit nervous. But my models also reflect that, and I flagged it before the week before election. I was like, this is actually getting to levels which is usually problematic. Now the markets haven't really pulled back like they may have because there's a lot of euphoria around the presidential around the new administration. Nevertheless, it's feasible that we sort of get a little bit of tightness around here, or the markets sort of peel off a little bit. But the bottom line is that liquidity is coming. The Fed has outlined it in the last meeting. They're going to start basically doing more nuanced, I think, measures, because I think the term QE is retired. Like optically, they just can't do it again.
Well, they just call it something else.
Yeah,
right?
It'll be programmed. Like these initiatives that the Fed was announcing is like, I'll tweak the overnight reverse repo rate. We'll do things over here. In 2023, it was the bank long-term funding measurement, which was sort of like this ad hoc liquidity for banks, ad hoc liquidity facility for banks. It's all going to be these kinds of things tweaking at the edges because they just, I think the market has cottoned on, and also people are just, I think from their perspective, it's optically bad to be seen just to be outright doing QE, but it'll be QE by another name. So liquidity, the outlook for next year looks pretty good.
Yeah, and so are you a dollar higher or a dollar lower?
I think it has to go. I think it goes lower now. I mean, the market seems to lag. Like we could sell off a little bit around here, but seasonally we're in a very bullish period, and it looks like the DXY is topped out. Treasury volatility, like the MOVE index, was at a 12-month high like 3 weeks ago. It's now back down below 100. It was 136 thereabouts, which is high and problematic. It's now come off. It looks like the dollar's reversed. So unless the central bank's got some political motivation here, it kind of feels like we've probably seen the end of that liquidity tightening, and that we should just ease into next year with some actual real policy initiatives coming out, not just from the United States but also China, Bank of Japan, and BOE.
And Fed cuts again this year or not?
Is there a meeting tomorrow?
Yeah. There's one more meeting. So whether it's tomorrow or Wednesday, I can't remember.
Yeah,
I'm not surprised they cut so much this year, but they've got a relatively big interest bill. But the market's telling them they need more yield to buy the bonds, and they've lost some pretty significant buyers along the way. Clearly.
Yeah. I mean, I haven't really digested the tweets that came out over the weekend with Trump threatening BRICS nations about not supporting the dollar and settling in their own currencies. Yeah, that's one for the geopolitical experts. But it's interesting the way that the US is going to go very, very hard around dollar being maintained as the reserve currency, and how these BRICS countries, which I think under a weaker administration, let's face it, over the last 4 years, felt emboldened to really forge this sort of multipolar alliance or multipolar world through the BRICS negotiations. I wonder if that changes. I'm not too sure what it means for the dollar just yet.
And so you think that potentially, I mean, did they get them back on SWIFT? I mean, that was one of the worst, central banking decisions for a long time, right? You're telling people to go elsewhere, correct?
Yeah, I hadn't thought about that, Ash.
I mean, you're
to be
forcing
honest.
people to
to
invent a new system, right?
I mean, look, you couldn't have asked for the silliest policies over the last 4 years than what we saw. Essentially, the die was cast when what happened with the Ukraine and Russia was played out and kicking them off the SWIFT system. So I don't think you stop that train. Like, China and Russia have invested in, I think I'll get the acronym wrong, but they've got their own system. They're bringing on BRICS countries. So the US can probably slow it down maybe, but I think that's got its own momentum now. I don't know if Russia gets brought back in. I think it would be constructive if they were brought back in, but I just don't know whether the motivation is there from the US or whether the Russians at this point would even do it. I mean, yeah.
I mean, it's diplomacy, right? You offer it to it if they don't take it up. But when it happened so brutally, and they had assets offshore that were frozen, you've got no other option.
They changed the rules of the game, and therefore it was a fork in the road, and we're now on a different path to the one that we were on, leading into that conflict.
Yeah, no, I agree. It's bizarre to think about it. People have studied this for years. So just sort of getting back to the digital asset space, obviously Bitcoin flirting with 100K. How do you think about the sort of altcoins versus Bitcoin here? I mean, obviously you and I think about, portfolios and a lot of assets outside Bitcoin. How do you think about that now?
Well, I mean, it's looking more like we're entering into an alt season just by the breadth of altcoins that are going up now. So a couple of indicators that I use in the research that I produce for Real Vision. So market breadth is like, old school market breadth in equity markets. Um, I don't think really gets done well at all, if at all, in crypto. And that's something that I focus on in the research. So I have like an alt season indicator, I have different breadth indicators. And what I'm seeing is that the breadth of the moves in the entire market are broadening out. So, you know, at the moment, I think it's like 45% of the top 200 coins are actually outperforming Bitcoin on a 90-day basis. But everyone looks at the Bitcoin dominance chart. And the Bitcoin dominance chart is somewhat misleading because this cycle, Ethereum has been a laggard, and Ethereum is half the altcoin market. So if it's not performing, Bitcoin dominance is still going up. Meanwhile, the rest of the coins could actually be outperforming Ethereum, but still that Bitcoin dominance chart continues to go higher for Bitcoin. But the alt season indicator that I've got shows that with 45%, actually that's getting to where in previous cycles you can say we're in an alt season. It just doesn't feel like it because of Ethereum. In saying that, Ethereum has been outperforming the last couple of days and it's really picked up. And if you look at it on a Ethereum versus Bitcoin chart, it's been trending down. It's now back at the top of the channel. It hasn't broken out, but it's like challenging that downtrend that it's been in. So I think we're at a very interesting juncture. My feeling was that Ethereum was going to have its time in this, time in its sun this cycle. It was a laggard. But as you get Bitcoin at 100,000, and it's certainly, in my opinion, it is going higher, you'll start to see institutions that, all came into the space through Bitcoin look at other opportunities. And there is only one legitimate alternative to Bitcoin in the institutional market through the ETFs, and that's Ethereum. And there is, there's a case to be made that Ethereum is cheap relative to Bitcoin based on, the price action, but also Ethereum's fee generation, despite the big cut in transaction fees from the Duncan upgrade in the first quarter of the year, has actually been like consistently up over the last sort of 6 months. And one of the things I'll look at is when Ethereum starts to break out on a technical basis, but also its fees. Like if you look at fees as a technical indicator, it starts to break out from its moving average, like 180-day crossover of the 30-day crossover on fees. When you get those two things moving together, like the probability that Ethereum's going to outperform is like 75%. So it feels like it's aligning now.
It's interesting because people, I'll ask you about the seasonality of it in a minute, but you always get this, call it Ethereum bashing in a sort of similar part of the cycle. And I think, I totally agree. When we talk to traditional institutions, people that are going to build traditional products on these networks, the only network they talk about is Ethereum to start with. Yeah. And that's because it is the, most secure. It's been around the longest. It is accountability passed on. Now, if we have this discussion in 5 years, I think what we'll see is people have built on Ethereum and then they go and find another network that solves for their problem. Now, whether it's speed, whether it's cost, whether it's, but it'll always start on Ethereum. And I just think I don't think people are going to skip over Ethereum to go, oh, let's get a faster or cheaper network to start with. So I think, and our sort of measure and conversations with people is the real world asset stuff is just warming up, right? Yeah. So people are going to start, that's going to start to come. And, as legislation improves, it's going to be Ethereum first. That's our view.
Yeah. Tokenization is a mega trend, and Ethereum is the most secure, decentralized. It has the largest network effect. So Web2 companies, there's just Ethereum and Daylight. Like Solana is a wonderful, it's fantastic infrastructure, and it's solving many different use cases. But for Web2 companies, I think I do agree with that thesis that they go to, and Web2 companies, especially financial Web2 companies, or that are in that financial domain, whether it's traditional finance or sort of like, the sort of the neo fintech type companies, they're going to do it on Ethereum. And they're going to do it via, an L2, which they control the fees and they can control the onboarding, similar to what Coinbase has done.
Yeah.
Like that's the model.
Yeah, totally agree. Altcoins, what do you like?
Well, we got Sui at 150, 160. So before the election, when the outperformance of Sui versus everything else started to really come through, we'd been following it for a while, and we put our not a recommendation, but a trading view at that time. And so that's been great. The other one that I quite like in the altcoin space is Nia protocol. So Nia is an interesting L1. It's basically it's proven, it's one of the few chains that's proven that sharding works, right? So it horizontally scales. It doesn't need to vertically scale like Ethereum. Ethereum for a long time talked about sharding, and then they dropped it for whatever reason. Nia has already gone through one upgrade where they've sharded the validator set, and so now they've proven that they can do that. They also have the second or third highest number of daily active addresses, and there's a lot less spammy activity on Nia. It's actually consumer applications. It's very concentrated, so there's only like a few apps, but they're Web 2 like apps, right? So there's a company called Kai, which is out of Singapore or out of Asia. They have like 25 million customers. It's basically a shopping app. They're using Nia to process micropayments for 25 million customers. So it's proven its use case in the consumer space. So it's really interesting because it's a very different set of dApps on the Nia protocol than on other protocols. The other reason I like it is that their founders are OGs of the AI space. I mean, Ilya, who is one of the founders, was a co-author on the Transformers paper at Google, which kind of kicked off the ChatGPT revolution very early, 10 years ago. He's now investing massively into decentralized AI on the Nia network, and I think that is also because of the AI meta going to do quite well. So that's the other L1 that I quite like, other than Solana. So they're the three L1s. I think DeFi is looking interesting because the blue chip DeFi tokens, like the Aves and the Uniswaps, I mean, they trade on a fraction of the price to fee ratios of L1s. So if you think about where do we go in this whole space, I think over time, a lot of the value has to go up into the applications because they're the ones who actually control the users. And so Aave, Uniswap, they've been around for many cycles. They trade on literally 90 to 95% discounts to what Solana, well, not Solana, but a lot of the other L1s, the more speculative L1s, even the ones that I've mentioned. So they're reasonably cheap. They've traded through the cycles. They capture the fees, and now with the regulatory situation improving, they're actually, the value accrual of their tokens is only going to improve. For Uniswap, they've never turned on the fee switch. That will change. So that's interesting. And then the other area, which is obviously everyone's talking about, is AI. And I just think that, at the moment with a $40 billion market cap of the total AI sort of space or thereabouts,
So
that goes up a lot.
Let's just clarify that. So that's 40 billion in network or tokens in the crypto space.
Yeah. I think that's circulating market cap. And all I did was I just took a list of the AI related tokens in the sort of top 200-300 and just aggregated them up. And that's currently what it's worth. It's, it's up 70% in the last month and a half, 2 months.
Okay, so let's have really quick, because we could go on a big rabbit hole, and maybe that's for another episode. I mean, AI is hot in every sector, right? How do you think AI plays a big part in the digital asset space?
So I kind of think about blockchain as being this real raw technology that has seen undoubtedly exponential adoption, but still represents an extremely small percentage of the global population. And it's still, even though a lot of the challenges around scalability and UI are improving every day, and that is meaning that more humans are coming on chain and using it. Like for instance, what I just mentioned with the Near protocol and the Kai app. Users in Asia who use Kai on their phones have no idea they're using a blockchain. They have that Near is not mentioned anywhere. They have absolutely no idea. It's just a shopping app which they scroll through and they get discounts and they pay and redeem on the app using the blockchain. So the examples and use cases of really humans using blockchains the way we always envisaged without them really knowing it is starting to be realized, but it's still clunky in many ways. Point being is that I think AI agents are just starting. There is 8 billion humans. Whether we get 8 billion people on chain in the next 10 years is debatable, but whether we'll see 8 billion agents on chain, I think is possible, but more possible. And so I think blockchain has been like, basically the technology is basically going to facilitate the AI agent economy because of just AI has no problem, bridging asset swapping, maintaining private public key sort of cryptography technology. It's harder for humans to do that. So it's almost like it was custom built for AI, but we didn't know that at the time.
Yeah, so let's just talk about the AI agent. So let's just run through an example. Say I want to buy a new pair of glasses. Can you just run us through that example of how you ask the agent and the payment? The transaction is recorded on the blockchain, but potentially the payment on
yeah,
crypto as well.
Yeah. Okay, so it's a good question because I'll sort of I'll talk through how I'm thinking about it and also where we are today with this being realized. So at the moment, you can't do what I'm about to say, but it's about to happen. I know teams that are working on it. So the way we're interfacing with AI today is through a chat box, right? Like we're just prompting ChatGPT or Perplexity or something. So I think it's going to be exactly like that. You're just going to prompt. And now whether the agent is connected to a wallet that you control, most likely if you're doing the purchasing, then it has access to your wallet. And this would have to be a smart contract enabled wallet where there are features set into or programmed into the wallet. Things like, okay, the AI, you can set limits on the transactions, either the number of transactions or the total amount that can be withdrawn. But the AI agent essentially have access to your wallet if you enable it. And then you'll prompt it to make a purchase for glasses. You'll give it the parameters that you're after. But then really where that seems relatively straightforward. Where it gets really interesting if it's a multi-dimensional prompt. Like, okay, let's say you've got you want to maximize for the number of points on one of your credit cards. You want it to purchase the set of glasses from a certain type of retailer that meets your requirements, whether it's Australian made or whatever it could be, and then you could also prompt it to whatever give it a limit of what you want to spend, and then any of the leftover funds, if it manages to buy below that limit, could be deposited into a DeFi protocol, earning yield on Aussie stablecoin that hopefully you guys launch or one of your affiliates launch, or USDC. So it's that multi-layered prompting that an AI agent will be able to do, and it'll interact with other AI agents to get it done. So that's the future that I think we're rapidly going into.
It's actually amazing. I want to buy a pair of glasses. It's got to be Aussie made, sustainable. Find me the best place when that get delivered as quick as possible or at a certain time, and for the balance of the money. Put in a yielding asset.
And also I've got 5 credit cards potentially, where can I maximize the points with each of the different credit card companies with the retailer? So match that information to my purchase information as well.
And that's it'll execute every step of that. So it needs it'll acquire the glasses, but then also how does it pay for it, which will be a digital asset of sorts.
Yep.
And then obviously the balance, or you've got some savings, put it into the most efficient digital asset to earn money.
Yeah. And also, if there's a step in that process which can't be executed, then it won't do the transaction and not complete the full task. So it would just not go through. Like, imagine if you're trying to organize flights for the family, hotels, itinerary, and various other things for a trip, and then like it executes half of it but doesn't execute the other half. Maybe like the hotel, and then you've got flights but you haven't got the hotel. So you can execute these transactions contingent on one like of everything actually being true, like an if statement, and when you're programming. So that ensures that you're giving it complex tasks, but it doesn't leave you in the lurch if like it doesn't complete half the task, and then it sort of nullifies all the other bits of the transaction.
We've all been through those things. You book the
which
flights,
we do when we're booking flights, right?
manually, right? Your flights, or someone can't get on the flight, or you can't get accommodation because you generally do it in that order. No, it's fascinating, and it's so. I think that probably segues into the next sort of point I want to talk about. Just quickly, everyone's talking about corporate balance sheets, so we won't go there. Micro strategy and Michael Saylor doing a lot of work there. I'm just going to go straight to the government adoption. So obviously the legislation around, let's just say the example we gave then, legislative, what's going to drive that? I mean, we're going to have sort of realization of, tokenization. Digital certification supersedes paper certification.
Mm-hmm.
Obviously, in Europe, that's happening under the MiCA legislation. What's your thoughts on government adoption? And then we'll go into digital assets on government balance sheets, whether that's the US or Australia.
Yeah, so whether it's BlackRock or Michael Saylor, it's clear that the very highest echelons within at least the US government that tokenization is being looked upon very, very favorably. The finance, I think the finance sector, I mean, BlackRock being one of the largest companies in the space, is obviously hurtling the industry towards it, but there's also everyone behind, the BlackRocks, whether it's the banks, mid-tiers, even some of the large banks, who are reluctantly now thinking that this is actually where things are heading. So the momentum is very, very strong around tokenization. So I think, that bodes very well for, seeing more adoption of blockchain, which just simply feeds through into the valuations of the asset price. If we just sort of go back to sort of what it means for the sort of the asset class or the market caps, I mean, it's very clear that adoption drives the value, right? So more people using it, more fees get generated, more validator rewards, that encourages more investment, market cap goes up. So it's very bullish for just being in the space and being exposed to, the infrastructure of the space, the blockchains themselves, without getting into the arguments of like where there's better value between applications versus blockchains. So it's really, really positive. So I think that moves ahead. It will start with the easiest products to tokenize, which will be a lot of financial products. Where it gets a bit tricky is physical products, like, certainly a lot of projects focusing on real estate, collectibles and whatnot. That eventually happens, but I think the sweet spot will be just tokenization of financial products, eventually stocks on chain as well. So it's, from that perspective, it's very constructive.
I mean, I think that's right. I think our view is that instantaneous settlement, or atomic settlement as we call it in this space, is, just has to happen, right? T+2 type scenario is very legacy, and it's one of the great credit risks or settlement risks of the entire system. But I also think that, the example you gave before about the airplane flights and the hotels and stuff like that, that should all be tokenized, right? It sits in your wallet like it does in your phone now. I mean, essentially the functionality is tokenized. It just means it's not recorded, and then The other thing I always find, if you cancel a flight or a hotel room, you get the money back, but it takes weeks.
Yeah.
And that's, I mean, who's making money out of that? It's the treasury at the hotel or the airport.
Yeah.
That should be a transition of value at exactly the same time.
Like it, it baffles me how much friction there is in the global economy with a legacy financial system. If we just unlocked that friction and sort of have that money basically flow back into the economy through innovation, then this whole, you know, argument about like debt levels and growth levels, there is definitely a mismatch. Debt is growing faster than growth. Well, global GDP is maybe about 100 trillion, right? So then if you've got the finance sector representing maybe 10 to 15, maybe 20% of total GDP, like, no offense, finance industry does an amazing job. Let's face it, the technology is antiquated and outdated. If 10 trillion was to flow out of the profit centers of financial institutions, sorry if you're a financial institution, but if it was to flow out because of efficiencies with moving money, value, settlement, authenticity, all these rules around, AML and whatever that sort of shut down a lot of value transfer, and it could be authenticated with, an immutable blockchain. That value just means that we get to do more stuff and create more things. So,
which is productivity, which
huge.
The Western world is missing. I mean, I totally agree. The problem is there's business models built on delaying returning your money to you, as in extra days, we'll take the interest, slow to get it back to you. The problem with that is it's not productive at all.
Nope.
It's, and the problem, as everyone's sort of alluding to or working out now, productivity needs to rise and quickly if these debt levels are going to, get addressed at all. And sitting money in an institution earning another week, 14 days worth of interest is not solving that problem.
Amen, man. But also, like, you can see how big the problem is, because it's not just supporting the financial system and the vested interests that have grown up under that sort of regime, but if they're capturing the value, or they're capturing the profit from the float, right, from having customer funds sit there for a period of time before they have to return it, whatnot, which is the business model of a lot of financial firms. What are they investing in? They're investing in government debt mainly. So it's like, it's a multi-level problem, because the governments need buyers for their debt. But if we could get governments to just flip the thinking and say, actually, we should just be pro-growth, and therefore you wouldn't need to basically issue as much debt, and therefore the banks wouldn't have an easy conduit to basically fund them, to make excess returns from floats. If you just flip it and just say growth first, easy settlement, low friction, then that the debt to GDP equation starts to move in the right direction, as opposed to where it's been heading for 20, 30 years now, which is just debt growing faster than growing faster than the actual economy.
Yeah. I mean, I think it's such a systemic problem that it's not just financial institutions. It could be hotels. It could be, you return a piece of furniture, anything. They're all working on this. We'll keep the interest for a couple of days. It's systemic. But that leads us into the sort of Bitcoin on sovereign balance sheets. A lot of talking points. I think the poly market betting has got the US at, I think, 15 to 18% of it happening. Strong push from some of the newly elected senators. What are your thoughts on that?
Look, it's actually it does require a lot of thinking, because on face value, it's extremely bullish for Bitcoin, because obviously you've got a new buyer and a large buyer. If they start conducting purchases of $200,000 a year over the next 5 years, well, Bitcoin's going to be worth a lot more. There's a couple of things though. I'm not clear. Like, firstly, it's interesting that the US would just be so open about their intention to do this, because it means, it just incentivizes everyone to front run them. right? The second thing is, even though you've got Bitcoin on your balance sheet, the problem, the fundamental problem, as I see it, and the reason why Bitcoin has gone up in value is we're all being debased by governments. If you don't marry a Bitcoin strategic reserve policy with a policy that says we're just going to stop we're going to stop or slow down deficit spending, then yes, Bitcoin will rise and it will continue to rise as governments debase us, right? So we'll have Bitcoin sort of just being accelerated and accelerated. But essentially, we want a world where we have some sort of financial stability. Like our governments recognize that, they shouldn't be stealing our time and our effort through currency debasement, and that, wealth should sort of flow more so in the private economy. So I just, like, obviously, Vivek and Elon and this Doge is going to address the government spending side of it. So as long as that becomes instituted in a very, very long-term fashion and it doesn't swing with the next change of government back to like deficit spending, like you've got to have both things. You've got to have strategic reserve, I think, to shore up, I guess, a new way to back their currency, and also a reduction in government spending so the debasement slows.
Yeah, so
that's my idealistic, hopeful scenario.
I agree. And I was going to bring it up. We're going to put the chart up on screen now because optically, call it Bitcoin, call it any sort of fixed asset, it looks like that price is going up in and of itself, right? So the monetary policy or the liquidity is staying the same,
right?
And
it's
the
like static,
and that asset price is going up.
Yeah.
When in reality, this chart's amazing because you've got the asset going up, but you've also got debasement happening. And call it in Australia at 7%, the US, I think it's 8%. This is monetary debasement, not including, goods inflation.
Right.
And I think it's still the most important thing. But it comes back to call it a reserve against the fiat system. Now, it was gold, and that created an accountability to the governments. Does Bitcoin replace that, or do we just continue to debase until there's no more debasement left, as in the fiat system? There's a hiccup.
I think this next sort of 2 years of the US government will be fascinating in terms of the direction we actually move in. The acceleration in debt levels in the last, or ever since COVID, have been so extreme that even if they were just to hold debt where it is and not spend anymore, that would be a massive, massive improvement. So I think that it kind of does boil down to what the US does. Like what Milei has done in Argentina wouldn't be remarkable to Austrian economists because they said this was actually the formula to rebuild an economy. It's just shocking to Keynesian economists who said Milei could never do it. But Argentina is like this, this fringe country or basket case country, so we can't really take too much from it, although you could take a lot. Like really, the lessons are there. It's if the US starts to execute on a more fiscally responsible path, it could really set the change for a lot of Western countries that have been following the US's lead and basically just growing their debt, at the expense of the private sector. And all the externalities and repercussions of that, whether it's, creeping authoritarianism or reduction in civil liberties that come with an ever, ever, ever increasing government sector. So I think the answer is I don't know what happens, but I think we've got hopefully an administration that can execute on a new direction for governments and government spending.
Yeah, I think it's very clear. I think their intention is, for this type of stuff, very good, right? Now, you can't go and cut, $2 trillion out of expenditure and be loved by everyone, clearly, or come across some resistance. And is it inflationary? Not sure. It's hard to tell, right? It's how they do it. Tariffs, historically have been inflationary to an extent.
Yeah.
So can you know, it's a tricky situation. I think in theory it all makes sense.
Yeah.
But you know, sort of our view is that you know this type of stuff is supportive for the digital asset space because you want more, you know, more productive use of time and resources.
Which blockchain enables. So
With the AI, as you
Yeah.
alluded to earlier.
yeah. So if they cut government spending and accelerate blockchain adoption, even though there might be some issues on the liquidity side with less government spending, ultimately it's still very, very constructive for the technology because we don't want blockchain asset or digital assets to go up just because we're being debased. We want it to go up because it's being used.
And functionality, absolutely, absolutely. So, Jamie, we could talk about this for hours. Thank you for all your support this year. Would you any holiday season words of wisdom from you for the listeners?
Words of wisdom, I don't know. I think next year is looking bullish again, but we're going to get your typical bull market corrections, 30 to 50% along the way. And like anything, I mean, not like anything, because sometimes the messages are different in the marketplace, but certainly when it comes to this space, I think it requires a long-term view, but it's not the market environment for those that are individual investors unless you're really experienced to be, playing around with leverage. You can hold the core assets that's really the assets that'll be around in 5 to 10 years time and still do very well with as your core portfolio with a residual peripheral part of your portfolio exposed to some of the more let's say exotic fun stuff. But as this market sort of goes up, the inclination to start going out the risk curve increases, and so what we're just saying to our Real Vision community is, stick to your asset allocation decisions and, don't increase risk as we extend into the bull market, which is, where I think we're heading in 2025. So that's just some thoughts on positioning.
Yeah, great words of wisdom. So, Jamie, thank you as always for your words of wisdom and your insights. Hopefully get some rest over the break because I think 2025 is going to be very interesting. To our listeners, thank you for listening to Unblocking the Chain. Again, happy holiday season. Hope you get some rest as we get ready for 2025. Thank you.